A beginner's guide to investing. What is investing? Putting your money into assets like stocks, bonds, mutual funds, or real estate with the aim of earning a return over time. Risk versus return. Higher potential returns often come with higher risks. Time horizon. Short term, 1 to 3 years. Medium term, 3 to 10 years. Or long term, 10 plus years. Define why you are investing. Retirement savings. Buying a house. Funding education. Building an emergency fund. Align your investment choices with your goals and timeline. Begin with a small portion of your income, 10 to 20%, to invest. Use dollar cost averaging, investing a fixed amount regularly, to reduce market risk. Spread your investments across different asset classes to reduce risk. Stocks. High growth potential, but volatile. Bonds. Stable, fixed income, but lower returns. Mutual funds ETFs. Diversified and professionally managed. Real estate. Tangible asset with long-term appreciation. Savings accounts / CDs. Low risk but limited returns. Focus on long-term growth rather than short-term gains. Reinvest dividends to maximize compounding. Assess your risk tolerance. Conservative. Focus on bonds and safer investments. Aggressive. Include more stocks and equity-based investments. Avoid emotional decisions during market fluctuations. Robo-advisors. Automate your investments based on your risk tolerance and goals. Examples: Betterment, Wealthfront. Stock trading apps. Easy for beginners to buy / sell stocks and ETFs. Examples: Robinhood, Whipple, eToro. Full-service brokers. Provide professional advice and personalized portfolios. Examples: Charles Schwab, Fidelity. Track your income, expenses, and investments. Analyze market trends, stock performance, and news. Examples: Yahoo Finance, Morningstar, Bloomberg. Learn the fundamentals of investing. Websites: Investopedia, The Motley Fool. Books: The Intelligent Investor by Benjamin Graham. Rich Dad, Poor Dad by Robert Kiyosaki. Podcasts: Bigger Pockets Money, the Investing for Beginners podcast. Create a budget. Ensure you're not investing money needed for short-term expenses or emergencies. Pay off high-interest debt. Prioritize paying off debts like credit cards before investing. Build an emergency fund. Save 3 to 6 months of living expenses in a liquid account. Open an investment account. Use brokerage accounts for stocks / ETFs or retirement accounts. Start with index funds or ETFs. Low-cost, diversified options for beginners. Automate investments. Set up automatic transfers to your investment account. Investing without a plan or clear goals. Trying to time the market instead of focusing on long-term growth. Putting all your money in one asset or sector. Ignoring fees and taxes that can reduce returns. Reacting emotionally to market volatility. Review your investments periodically, annually. Rebalance your portfolio to maintain your desired asset allocation. Stay informed about market trends and adjust strategies as needed. Start early to benefit from compounding. Focus on learning and improving financial literacy. Keep fees low and maximize tax-advantaged accounts. Be patient. Wealth building